It's my great pleasure today to welcome you to the Center for Global Finance Research Seminar today. And we are particularly delighted to welcome Professor Joshua Abor. And Joshua is a distinguished scholar and also who has a very profound experience in policy work. There is no easy way of presenting Josh. I also call him Joshua. Joshua at the moment is professor of finance, and until recently the director of the business school at the University of Ghana, Legon. He's also doing important roles with the central bank on the monetary policy committee of the Central Bank of Ghana, but also has undertaken a number of consultancy and projects for the World Bank, IMF, Africa Development Bank. I used to work with him when I was there. Indeed, as you can see from his very prolific work, quite leading in many areas of banking and finance. Importantly, he's an active member of the Center for Global Finance at SOAS, University of London, is indeed a co-investigator on the ESRC and FCDO funded project on inclusive finance. And this draws from that particular project. And of course, if you go to the Center for Global Finance website, you see a series of his papers, some published in top journals, 2 books, and also a series of working papers. Today, Joshua is going to share information with us on private capital flows and how these are related to inclusive finance. Indeed, fulfilling a very important component of our project, where we're looking at how capital flows affect the domestic banking markets and domestic financial institutions. So let's welcome Josh, and please, the floor is yours.
Thank you very much, Victor, and thank you for the opportunity once again to present this important platform. And let me say hello to everybody who is joining. So this is a paper I'm doing with 3 other colleagues, Eliplimi Agloyo, Richard Jungfor, and Lei Pang. The main motivation is really to look at how domestic financial markets and institutions affect the relationship between private capital flows and inclusive finance. Though we recognize that global financial inclusion has improved, especially improved by 18% between 2011 and 2017. Many people are still said to be excluded financially. About 31% of adults are said to have no bank with former financial institutions, or even having mobile money account. And we are talking about 200 million adults in rural China alone that are excluded from the former financial system. Now, others have actually argued that in many parts of the world, especially in low-income countries, inclusive finance is said to be a luxury. Previous studies on financial inclusion have tended to focus on determinants. What factors actually drive inclusive finance, looking at both supply and demand side factors. But the literature relating financial inclusion with private capital flows is virtually non-existent. And now we're very surprised scouting through the literature, not coming across works on the relationship between private capital flows and inclusive finance. But there's abundant literature looking at the relationship between private capital flows and certain outcome, growth and development outcomes. In fact, in the past few decades, the effect of private capital flows on economic growth, especially through the financial sector, is well established in the literature. We've seen a number of studies looking at that relationship. So how private capital flows, whether FDI, portfolio flows, debt flows, influence or affect growth in the presence of financial sector development and other local characteristics. Now, the interest is largely motivated by the inflows, large inflows through the rapid financial sector liberalization approach way back in the early 90s. The focus has mainly been on how private capital flows tend to stimulate fixed capital accumulation, how it allocates resources, how it interacts with labor resource, and how it deepens internal financial sector. So basically, studies looking at the relationship between private capital flows and inclusive finance have mainly focused on these key areas. Private capital flows can influence several economic outcomes, and importantly among them is the relationship between private capital flows and inclusive finance. But like I said, this relationship or this area of focus hasn't been researched. So in this study, we are interested in how financial globalization, specifically private capital flows, can complement policymakers and, if you like, reducing financial exclusion around the globe. Specifically, we look at how private capital flows drive inclusive finance in the presence of domestic financial markets and institutions, drawing on world or global data. Now, in terms of the extant literature, private capital flows through financial markets, of course, has the ability to facilitate the flow of funds from, if you like, surplus units to deficit economic units. Financial services can be extended to sectors or areas that were neglected in the past. And we expect intuitively that private capital flows, be it FDI, portfolio flows, or debt flows, can stimulate the supply of funds to these economic agents. The issue of private capital flows in the growth literature provides evidence of the dependence of these inflows on financial markets and institutions. Other studies, and of course, I did a study with Ajasi and also with Agboyo, Asama also found similar results that private capital flows indeed can affect growth in the presence of effective or well-developed financial markets. Now, others have also provided strong evidence that financial market development influences institutional, actually, financial market development and enhance or effectiveness of institutions can drive inclusive finance. So we also have strands of literature looking at, apart from determinants, looking at how financial markets and how strong institutions within the domestic economy can spur inclusive finance. So we've seen studies by Graham, Anafo, et al., all arguing that financial markets are good for promoting financial inclusion in Africa and other parts of the world. Allen et al. And Inquire and Song also argue that institutions, strong institutions for that matter, are very important in driving inclusive finance. So in terms of the gaps, we see clearly that yes, private capital flows can drive growth in the presence of well-developed markets, financial markets, strong institutions. And we also argue that financial markets and institutions are important in spurring inclusive finance. But what we don't see is how private capital flows affect inclusive finance. And we argue that private capital flows, of course, widens domestic credit, private credit base for those neglected from the former financial system and low-income groups. And this provides opportunities for them to be able to access formal finance or formal financial services. Now, despite this opportunity, the link between private capital flows and inclusive finance is yet to be explored in the literature. And this is actually the focus of our study. In addition to looking at the effect of financial markets on inclusive finance and also institutions on inclusive finance, we want to look at the roles these structures play in the relationship between private capital flows and inclusive finance. We also use the 6 governance indicators from the World Bank and examine their impact on financial inclusion, as well as their effect on the relationship between private capital flows and inclusive finance. Now, for our methodology, we look at financial inclusion being determined by a number of factors. So we argue that it will be influenced by private capital flows, it will be affected by financial markets, it will be influenced by institutions, and other standard determinants of financial inclusion. So we capture these as control variables. Financial inclusion is measured by the Composite Financial Inclusion Index, obtained by applying a principal component analysis on our 4 financial inclusion variables. And these are bank accounts per 1,000 adults, then bank branches per 100,000 adults, and ATM per 100,000 adults, then depositors with banks per 1,000 adults. So we construct an index based on these measures of financial inclusion. Then for private capital flows, we have the key elements being FDI, portfolio flows, and debt flows. And FDI defined as net inflows. So net inflows, you are looking at the difference between your inflows and your outflows. And then so we scale that by GDP. Then portfolio flows, we do same scale by GDP. The net flows on external debt, also scaled by GDP. Financial market also has 3 main variables. We have credit to the private sector, or private sector credit. to GDP, and then broad money or money supply to GDP, and then stock market capitalization to GDP. Now, for institutions, these are the governance variables by the World Bank. So we use these as our measures of institutional quality: rule of law, control of corruption, government effectiveness, political stability and absence of violence and terrorism, regulatory quality, voice, and accountability. Now, our standard determinants of financial inclusion are log of GDP per capita. So we use that as a measure of financial economic development, a measure of economic development. So we believe that economy that is well developed is able to drive inclusive finance because people have higher incomes to be able to access financial services. Then population, we look at share of population of those within the ages 15 to 64 as a percentage of total population. And again, the literature suggests that those who fall within this age bracket are the working class. And therefore, if you have a higher percentage of the population within this age group, then they are more likely to see inclusive finance, enhanced inclusive finance, because these people are working, and of course, they can access formal financial services. The mobile cellular subscriptions as a measure of ICT penetration, and we found in our study that the use of mobile telephony inclusion, financial inclusion, promotes inclusive growth. Others have found that the use of mobile phones promotes inclusive finance. So we expect a positive relationship in that regard. Then school enrollment. So we look at secondary and then tertiary. We believe that for tertiary, because most of them are exiting into the labor market, we expect a positive relationship between tertiary and inclusive finance. But for secondary, we don't expect a positive relationship in that respect. So our argument is that well-developed financial markets and quality of institutions should moderate the relationship between private capital flows and inclusive finance. We interact measures of private capital flows with measures of financial markets as well as measures of institutional quality. So if you take the equation we have up here, we throw in a standard determinants already. In our first model, we had private capital flows, financial market, and institutions. So here we have that. But if you look at beta 3, we are interacting private capital flows with financial market variables. I will do same for the next model. Here we interact, look at gamma 3, and that's actually our main variable of interest, where we interact private capital flows with measures of institutions. And of course, we control for the standard determinants of financial inclusion. So here, our main coefficients of interest are beta 3 and gamma 3. And we expect that the interaction term between financial markets and private capital flows should improve financial inclusion. Now, if that happens, then we argue that they complement each other to drive inclusive finance. But if the relationship is negative, then we argue that these are substitutes. You can either focus on promoting private capital flows to develop inclusive finance, or you develop your local financial markets to be able to promote inclusive finance. So while higher capital flows improves financial inclusion, considering the role of domestic financial market or well-developed local financial market. Developed domestic financial market may be enough to improve financial inclusion. So if the relationship is negative, what you're saying is that you can just focus on developing a local financial market, and that alone should be enough to promote inclusive finance. Now, if you look at Gamma 3, yes, it's the same argument where we have a positive coefficient. We argue that strong institutions can complement private capital flows in order to spur inclusive finance. But where the relationship is negative, then we argue that these are substitutes. You can either focus on developing strong institutions to be able to support financial inclusion. Because strong institutions, rule of law, you have strong court system, you have strong regulation, very effective regulation. These systems ensure that banks and other financial service providers operate in an environment that ensures that they are effective and deliver on their mandate. And if that happens, then we should see financial inclusion playing out. We also proceed to calculate the margins as indicated below. Now, we use the minimum, mean, and maximum values of the variables in the estimation to actually estimate the margins. Again, to capture the dynamic nature of our very first equation, if you remember the first equation we have, we specify the model also in the GNN framework. And here we argue that previous financial inclusion affects current financial inclusion. So we introduce a large term in the equation. So we're saying that the large financial inclusion or the previous year's financial inclusion may influence current year's financial inclusion. We also use two-stage least square instrumental variable approach to identify any causal effect between inclusive finance and private capital flows. We actually follow the IV approach to account for possible endogeneity issues with a first stage regression. And we actually consider treaties. And treaties here is the number of bilateral treaties signed by a country, and that have actually come into force. And we scale this by 100,000 of adult population, because remember, our dependent variable being inclusive finance is scaled by 100,000 of adult population. We believe that, yes, treaties will affect, has a correlation with private capital flows, but does not have any correlation with our independent variables. Now, we pull data from 2004 to 2019, so we're looking at 15 years for 90 countries. So we look at 90 countries across the globe. And data was obtained from the World Bank's World Development Indicators, Global Financial Development Database, and the World Governance Indicators. So just a snapshot of our variables, our description. So here you see that, look at the measures of capital flows, FDI, portfolio, and debt. And this is actually reflective of what we know, that FDI is more sustainable and mostly significant enough to drive growth compared with the other elements being portfolio flows and debt flows. I know portfolio has this counter-cyclical effect, that, or reversal effect, that investors can always fall and rediscount their investment at any time, and it's not sustainable enough. But FDI tend to be quite sustainable. If we look at measures of financial markets, we see money supply being the highest compared with the others, private capital flows and stock market capitalization. Now let's look at our findings. Very interesting results we see here. In the two-stage least squares and the GMM estimations, we find that FDI positively influences financial inclusion for all the estimations. Now, financial markets also have direct effects, positive effects on financial inclusion. We also find that institutional quality has a positively significant relationship with financial inclusion. For the control variables, the findings are as expected. We see that per capita income has a positive effect on inclusion. And then a greater percentage of adult population in the working class also positively influences financial inclusion. We see ICT to have a positive influence on inclusive finance. Now, while secondary education has negative effect on inclusion, tertiary education, as expected, shows a positive effect on financial inclusion. Now, the results from the GMM estimation show that portfolio flows also have a positive relationship with financial inclusion. We also found that domestic financial market, local institutions, as well as the control variables, all show signs that are consistent with our earlier estimation. So, financial market institutions all have positive effects on financial inclusion. Then we look at debt flows and inclusion, and we see that using the OLS estimation, debt has no significant relationship with inclusion when we use private credit as a measure of financial. But debt shows a positive and significant relationship with financial inclusion when we use money supply and stock market capitalization as measures of financial markets. Now, the two-stage least square results also show that debt positively influences financial inclusion when we use private credit as a measure of financial markets. But when we look at the results from the GMM, debts tend to have a positive relationship with financial inclusion. Again, financial market institutions and other control variables show signs that are consistent with our earlier estimation with the expected signs. So that is that for the direct effect of private capital flows, financial market, and institutions on inclusive finance. At this point, we are interested in the interaction effects of these measures of capital flows. So first of all, when we interact FDI with financial markets, we see a negative relationship. And that suggests that these variables are substitutes. So you can decide to grow any of them or develop any of them, and it should have the desired effect on inclusive finance. Now, the marginal effects at minimum and the mean are positive, with the maximum level of financial market showing negative signs. And this actually suggests that high levels of financial market may be enough on its own to spare inclusive finance. And that's why we argue that these are substitutes. Now, if we take the interaction of portfolio flows and financial markets, we see similar results. Again, checking the marginal effect, high levels of domestic private credit, here private credit used as a measure of financial market, may act as substitute for private capital flows. So again, if we use portfolio and financial market interaction, we see that the relationship with inclusive finance is negative. So we argue that these are substitutes. Then lastly, on the element of capital, private capital flows, we look at debt interaction with financial markets. And we see that it only has a positive relationship with inclusive finance when we use money supply as a measure of financial market. Here, higher levels of money supply, here we actually saw a positive relationship. So we argue that higher levels of money supply complement portfolio flows to exert or to influence the positive relationship with financial inclusion. Now, the coefficient of interaction between FDI and institutional quality variables are mostly negative. And we see that the marginal effect at minimum and mean are all significantly positive, with the maximum levels of institutional variables signaling negative signs. So we see that whilst institutions or the quality of institutions can exert a positive marginal benefit on FDI, on inclusive finance, high levels of institutional quality on its own may be enough to exert the needed impact on inclusive finance, hence acting as a substitute at this stage. So with these results, what are the implications? The results have shown that private capital flows have a direct positive effect on inclusive finance. Now, of course, efforts already in place in attracting private capital flows should continue, and we believe that governments that are putting in place measures to attract private capital flows, especially FDI, are doing that for the right reason, and we encourage that to continue. We also suggest that measures are needed to attract more private capital flows, bearing in mind the specific characteristics of the local economy. The findings have actually revealed possible substitution between private capital flows and financial market and institutions, especially for well-developed financial markets and countries with strong institutions. We argue that countries with low financial markets would need to do a lot more to attract capital flows in order for financial inclusion to take place. In the same vein, countries with poor institutions or weak institutions need private capital flows, especially FDI, in order to promote inclusive growth. Obviously, developing countries with underdeveloped financial markets, and weak institutions would need to do a lot more to attract private capital flows in order to promote inclusive financial development. Mr. Chairman, will conclude that policy interventions should be directed at attracting more private capital flows, especially FDI, in markets with less developed financial markets and weak institutions. Countries that have well-developed financial markets and stronger institutions need to focus on further developing these structures to support inclusive financial development. Thank you very much.
Thank you so much, Josh, for a very clear and interesting presentation. I think the presentation was really clear with interesting material, and so a number of very important issues, a clear motivation, good methodology and coverage, interesting and varied investigation, empirical investigation, and then interesting results on how what you found about the impact of capital flows, especially on financial inclusion or behavior of domestic financial institutions and markets. Okay, so so at the moment the floor is open. Let's get a couple of comments, observations, remarks, suggestions from the participants. Okay, Richard Alexander, yes, your hand is up. Please unmute and ask.
Yeah, thank you, Victor. Thank you, Joshua. I found your final point particularly striking, but it raises an issue, because if developing countries are in greatest need of FDI and have to work hardest to get FDI, then does that create an issue that they're more vulnerable to the suppliers of FDI imposing conditions on them that they are not well placed to resist? And does that in turn raise a risk of FDI causing potential exploitation? And I'm thinking particularly of the African context.
Yeah, thank you very much, Richard. Yes, Josh.
All right, so thank you very much, Rich, for the question. So from what we found, we actually noticed that for countries with less developed financial markets, they will need to do a lot more to attract FDI to support inclusion, financial inclusion. Because the markets are not developed to be able to extend financial services to the less privileged, to the vulnerable, to those who are excluded from the former financial system. The financial market is not able to do that. Again, institutions are not strong enough to protect financial service providers in veering into certain areas. So their hope will be to attract more FDI to support this agenda whilst they continue developing their local markets. It's not easy developing the financial system. It takes time. And especially the capital market, it takes a very long time. So whilst you think of getting a lot more people included in the former financial system, you need to encourage capital flows in the immediate term whilst you keep developing your local financial market. for developed markets, they have the luxury of saying that, look, we want to focus on our local market because the markets are strong enough, vibrant enough to promote inclusivity. Everybody can be included because the market is that robust. Or they can say that, look, we still want some private capital. They can decide what to do because we are saying that these elements are considered substitutes. Whichever way they go, they can still promote inclusive finance. Thank you.
Thank you very much, Joshua. Yes, Doug, you are welcome to the session, and you have a question or comment, please go ahead.
Thank you, Victor, for giving me the floor. And I thought this was a very excellent presentation, very interesting points being raised. Just one comment and one question. So I think the comment I would see sort of working on financial sector development generally and specific targeting around certain capital flows as always as complementary. But maybe that's also a question, I suppose. But it's that, in a sense, we want to attract more capital flows and we want to use it better. We need general financial sector development for that. That will help development, will help to attract investment. But there are market failures associated with financial markets. And in order to overcome market coordination failures, you need to have put actions in place to, for example, attract FDI, steer it into the right areas. That was a comment. My question was really a bit about difference between FDI and portfolio flows. I think the literature tends to say that FDI is a bit more beneficial to economic outcomes than portfolio flows, and I don't know whether you found it, particularly in the case of surges, and that there might be that portfolio flows maybe over the longer run might be all right, but if it comes in surges, then it leads to inflation, it leads to lots of problems. And there have been, I think, IMF reports in the case of Nigeria that sort of rapid inflows of portfolio flows have not been that beneficial, may not have led to financial inclusion either. And that basically, of course, if the quality institutions are in place, that will be helpful. But the problem is actually that it comes in so quickly and you can't deal with it. So is there some way in which you can use the regressions to also deal with the sort of the variability of this, and that if portfolio flows come smooth over time, it is beneficial, but if it comes in waves and in shocks and so on, then it's not beneficial.
That's a very good question, Daka. Yes, to see that we can explore, all possible permutations. So, Josh.
Sure. Okay. Thank you very much. So yes, I mean you are right. I mean the relationship between private capital flows and financial sector development, I mean, it's very clear in the literature. And the point I made earlier about private capital flows, for instance, driving growth in the presence of domestic financial sector development is quite clear in the literature. Now, in terms of the relationship between FDI and portfolio, yes, you are right. There's a clear difference. FDI are talking about investment of equity and also taking or participating in the management of these firms. So it could be greenfield investment, brownfield investment, but you're investing equity, a minimum of 10%, and you participate in the management of the organization. So you are thinking more long term. But for portfolios, you are investing in financial instruments, and this could be debt instrument or equity instrument. But they are assets you invest, which you can offload on the market at any time. In that case, when there are shocks, like you said, we experience this reversal effect. Investors will offload and exit the markets, and we're experiencing that in a number of countries. I mean, with the emergence of the pandemic, we've seen investors pulling the plugs and returning their investment home. But we don't see that with FDI, because you invest and you want to make sure that the capital stays long term, and so you develop the business. Now, for this data, we looked at world data. So it's not surprising we are seeing this. Studies that focus on only Africa or developing countries actually come out with that particular finding, that portfolios can have adverse effects on growth because they are not sustainable. They are not sustainable. And we are not looking at growth, but we're looking at inclusive finance. Maybe if we looked at growth, probably we'll find something similar even for the world data. But we are just focusing on inclusive finance. So in spite of how little it is, it can still drive inclusivity. Thank you.
Yeah, thanks, Joshua. And I think that, excursion into the variations of capital flows helps a great deal. Now, we have also a question from Dr. Peter Rose. Thank you, Peter, for once again participating in these seminars. So if you'd like to unmute and ask your question, and after that, I'll go to Kwabena Poku. So, yes, Dr. Peter Rose.
Thank you so much, Professor Murinde. And I would like also to thank Professor Joshua. It's a very good research paper, and I commend you for that. Nevertheless, I'm very interested in your paper. You've touched on a very important topic. It's about foreign direct investment and inclusive finance. I suppose the best test to quickly assess the relationship would be a co-integration test. You could also have done that. But nevertheless, there are so many options that you could have done in terms of using statistical analysis to find a direct relationship. But my question, we've reached a critical point. It's not only developing countries, it's developed countries we are really competing heavily for foreign direct investment. We are in a very critical stage. So therefore, my question, how with a weak institution, which most of the time the developing countries has weak institution, can be able to compete with the developed countries' strong institution to attract foreign direct investment? Thank you so much.
Thank you, Peter. Yes, yeah, the competition is always on, and especially now with the slowdown in the flow of resources. I think your question is very timely, Joshua.
All right, so thank you very much. And I will consider that particular recommendation. This is a work in progress. So we'll be happy for inputs. We incorporate that in revising the paper as we get it ready for publication. So we'll consider that. Thank you very much. Now, yes, developing countries do not have strong institutions. So clearly, there's a country level risk you need to contend with. The standard finance theory tells us there's a risk-return trade-off. And so if you have African countries with huge potential for growth, but they are exhibiting some risk, you need to decide as an investor, foreign investor, whether it's a market you want to go in. A lot of these developing countries present exciting growth potential, investment opportunities. And I think if these are well presented, they can attract FDI in spite of the risk. Of course, they will be offering very exciting and interesting returns, and you should be able to attract foreign investment. A lot of developed countries have hit their growth targets So opportunities for growth are limited. So you don't have much opportunities in terms of investment. So these are things that investors will look out for. Yes, will you go to a very safe terrain where you are getting low returns, or you go to a country with high country risk, by offering exciting returns? You need to be able to look at both. Of course, we have investors that will say, yes, we'll consider the risk, but we still want to come in there. So you can still present exciting potential that investors will be interested in.
Thanks, Joshua. And especially that's a good question from Peter. Response from Joshua as well, good, because of the rapid changes in the financial market environment in different countries. In fact, if we think about the transmission mechanism, how this happens, in theory, how does this happen, then we can take into account those variations. Now, I have also the hand up from Kwabena Apoku. Kwabena, please unmute and ask your question.
Thank you, Victor. Prof. Joshua, thank you so much for the comprehensive research. And I was very happy to see that you included a vast amount of data spanning different countries. You said about 90 countries. And my sense is that it's both developing countries and developed countries, right? Which is great. Now, looking at the data, especially the variable for financial inclusion, okay, you have branch, ATM, deposits, and accounts, right? Now, in the developing world, you see a big shift away from, I would say, brick and mortar banking to more of direct banking, which is online banking with all the other attributes. So shifting away from branches, if you will, and then from ATM, especially developing countries. Now, looking at this composite variable as an index for financial inclusion, I don't know if you looked at the shift in terms of the environment away from brick and mortar to direct banking. If you account for that, okay, would that change some of the results, or would it be also helpful if you wanted to separate those from the developing countries, where I think that brick and mortar is still very important, but in most developed countries now we're going more into direct banking, less of branches, into direct banking? Would that change your results, or is it something that would still make your results still valid across both developing countries? Victor, we can't hear you.
The suggestion. Right. Thanks, Kwabena, for those questions as well as suggestion and comments. Very timely. So, Joshua, I'll give you a chance to respond in detail.
Yeah, thank you very much, Kwabena, for the excellent question. This is something we really consider this. The issue was with data, and most of the emerging issues with respect to fintech and innovative banking. Data is not readily available, so we really struggle with data. But we'll still look around and see whether we'll find data apart from what we have, the traditional measures of financial inclusion. So that's a very good question.
Yeah, thank you indeed. And I think there is a related question on just, going into the details, which basically could be motivating researchers here, including Josh, for the other paper that goes into, kind of decomposition, trying to go into the details. And so there is a similar question by Aisha Demir posted in the chat. So Aisha is very much working in these areas, of course, has been working with you as well on these particular areas. So Aisha.
Thank you, Joshua, for this insightful presentation. I have a suggestion on your financial inclusion composite measure. As far as I'm aware, you did a principal component analysis by incorporating 6 measures of financial inclusion. What I would suggest is whether you have considered to divide these measures based on their concepts, that whether they represent access, use, or quality dimension of financial inclusion, and how private capital flow affect each dimension rather than the composite measure of financial inclusion. So this will also enrich your analysis in terms of looking into each dimension of financial inclusion. Because it may well be the case that private capital flow may increase access, but it does not have any effect on the use dimension of financial inclusion, which eventually do not contribute an increase in the activity of financial transactions. So looking into impact of private capital flow in each dimension will also bring out more healthier results in your study. That's also a suggestion.
Thanks, Aisha. It's very important a comment on decomposing or disaggregating financial inclusion. You said use, access, and quality. I could also actually add cost. Cost is a very
Yes.
a critical variable that has perpetuated financial exclusion in many countries in the world. Simply, households and companies cannot afford the money in terms of cost. Or if they afford the money, then there is a problem of information asymmetry, moral hazard, and adverse selection. They afford the money because they are not going to repay. Okay. And when they don't repay, then that results into non-performing loans. So, good question or good suggestion for decomposing that to Joshua, depending on what data he can access, I guess.
Yeah, so thank you. That's noted. I think another dimension is quality. So we'll look at what data is available and then we'll incorporate that.
Yeah, thanks, Joshua. Yeah, and actually on quality, I always think that is straightforward. I always think about it. I haven't done it, but I always think about it. That the quality dimension, I would look between short-term and long-term. Okay. Because I suppose that in many countries in the world, you have access to short-term or even medium-term, but long-term, you struggle. So setting up something, long-term investments becomes a challenge. And so maybe the quality could easily be dealt with by just simply distinguishing between short-term finance and long-term finance. Okay, I'm looking at the chat room. Any further comments? I'm looking at the hands up. I think Peter is an old hand, maybe. Then there is Kwabena is an old hand, but if it's a new hand, please let me know so that I can call you in. And I saw a comment from this young man, Jeffrey. Jeffrey, how does the quality of information sharing matter? Quality information sharing. In the regression, say you have there is very good coverage of the institutional quality variables, which Aisha also loves, but something extra would be on availability of information sharing mechanism. For example, credit bureaus. For example, registry information registry companies, which would then, of course, facilitating the transmission mechanism between capital flows and financial inclusion. So I don't know whether you want to make a comment on that, Josh.
Well, I will assume that that will be subsumed under effectiveness of government or government. So are effective, then you expect that information will be easily available to all parties, that asymmetric information can be dealt with every now and then. I don't know, because what we did was to just use the standard, the 6 measures of institutional quality, and this is what is used all over the World Bank and other places, and standard research has these variables.
Can I just extend the question a little bit, if that's okay?
Yeah, sure, Jeffrey. Yeah.
Yes, I was going to ask, because this new registry that just came out, the new online collateral registry, which allows, people and small businesses without access to formal finance to actually come on and register their collateral, or small businesses for loan. So, and it shares information about credit. So does this sort of platform that combines both use of service and information sharing. So what do you think about this link and financial inclusion? Because it's different from the traditional bureau and registry. This one is online, which allows people from any part of the country, even from the village, to register with their mobile phone and just register their machines or something for access to finance and share their information.
Thanks, Jeffrey. But before I ask Josh to respond, could you assure us that data is available? Say, if one was to do across the world, like Josh's paper is really taking the universe of the world, would the information be available on every country of the world for the last 100 years?
No, not 100 years, because
Okay.
I mean, 100 years ago, there was no internet anyway, because this one is an online registry which requires internet. So I would say in the last years or so.
And for how many countries, for example?
Over 100 countries that have actually adopted the new online registry. So it's there will be data available for it.
Okay. So I can now turn to Josh to see if he has anything to add on this here.
All right. So with the registration he described, I mean, it's not different from the village banking model that is used in microfinance. So where you encourage the potential applicants to register, and then based on information you have on them, you decide whether to extend credit or not. So I see it to be a village banking model used in modern times. But in terms of the information, I still believe that if government entities are playing their role well or functioning properly, they should be able to access information about all the parties. Recently in Ghana, during this COVID era, the government actually tasked an agency, the National Board for Small Scale Industry, to receive loan applications from small businesses that have been affected by the pandemic. And they received countless applications, but actually weeded several of them out because they provided wrong information. So I believe that if the structures are working and they're effective, you should be able to access good information about loan applicants and take a good credit decision.
Thank you, Josh. Any further comment, suggestions? I'm just going through the chat. I don't see any further ideas in the chat. Going through the list of names. I don't see any hand up. So I think, yes. Let me see. There is a hand now that has come up. Yes. Peter, your hand is up.
Thank you so much for the second round of questions. Given the state of the COVID now, there's a whole new dynamics taking place as far as flows are concerned. There are quite a number of countries having trouble because as a result of the economic downturn, for them to attract foreign direct investment and capital flows. How do we deal with such a phenomenon? Thank you.
Yeah, thank you, Dr. Rose. I think that's very, very, very interesting question. So we're thinking, we're just trying to look at this new knowledge we've got on this paper and try to think about, the actual problems confronting us today. And these are very real. Actually, they get more real even if COVID comes to an end after 1 year, because governments would have to reconstruct their economies and get things back into activity. So yes, that's a challenge. I guess we could have a number of contributors here on this question, but let's start with Joshua.
Okay, so Victor, if I heard the question right, so he's asking about the impact of the pandemic on, let's say, financial market, capital flows. Is that a question?
Yes.
Okay, all right. So that's a very good question. Clearly, the pandemic will affect capital flows, and it's affecting capital flows. It's affecting financial markets. It's affecting institutions. Some of us believe that the pandemic is still raging, and it's difficult at this stage to ascertain the full effect unless the pandemic is all over. If it's over, we would then have to ascertain the full cost or impact on economies, on markets, financial markets, on institutions, and so on and so forth. And of course, on foreign investment. But we see that on a continuous basis now, we see some impact on the banking sector, of course, affecting deposits. Interestingly, during the lockdown, deposits really went up in a number of countries. I mean, the UK, here in Ghana, deposits increased. The pandemic is affecting loan extension. Businesses are collapsing, and therefore banks will be affected. Stock markets are tumbling. We can talk about microfinance institutions. A lot of them are folding up. Investment companies, people are rediscounting their investments. So financial markets obviously will be affected. Private capital flows, yes, people will hold back on their investments. But interestingly, the pandemic, we didn't see much impact on remittances from developed markets to Africa. And maybe that may be explained by the rationale for the remittances. Is it for investment or is it for upkeep? And we know that in many African countries, the remittances they receive are for upkeep and taking care of families. So we still see that happening. But of course, private capital flows is being affected. Institutions, yes, government are thinking of restructuring government establishments to make them a bit more responsive to shocks. So yes, to answer your question, yes, affecting, but like I said, the extent of impact can be ascertained after this whole thing is over.
Thank you very much, Joshua, for that response. I know you have done another excellent paper of yours, which is actually on the website of the Center for Global Finance here at SOAS, University of London, in which Joshua and colleagues look into the implications for COVID-19. And so definitely it will be worthwhile for participants to look at that paper. He has just given us a little bit of a appetizer opening to look at that particular paper. And just a quick comment. I note with appreciation, Josh, that you're having a IT implication. Basically, I think broadly, there is an element of fintech or any form of a communications and information technology in this paper, which I think that I agree that developments in that area are likely to increase both components of the arguments here. First, a component of capital flows, to increase as technologies become very available. For example, in the area of FDI, in another area of, say, for example, remittances. Remittances, if I could take an excursion into the remittances, the availability of overnight, that is a 24-hour display of remittances, has worked. And these remittances, of course, could be used domestically for a financial inclusion. So maybe excursions into other areas of fintech, ICT building on fintech, particularly interesting. But if I could make a quick comment, a quick question, give a quick question is like all the researchers, when we listen to all this work, we're always saying, okay, where do we go from here in terms of future work? Where do you appoint a number of the participants, researchers who are burning the midnight oil to start on some new work? So now that you've done this paper and completed it, where would you like to point these researchers to go? Just briefly, maybe that would be helpful.
All right. So thank you, Victor. So I believe there are quite a number of interesting things that can be looked at. We initially mentioned the issue of growth. I mean, studies have looked at capital flows on growth, but what we haven't looked at is inclusive growth. So can future studies consider inclusive growth or development as opposed to the traditional measure of economic growth? You can experience growth, and for a number of African countries, you see government posting exciting figures for growth, but the growth is not inclusive. So if we want to encourage private capital flows, how does that trickle down to affect local economy? And then the effect of private capital flows on the domestic financial system. So here we've looked at effect on inclusion, but how is it, for instance, affecting banking, the banking system? How is it affecting the capital market? So this, I think, we may want to consider. And then the exciting area of fintech. Is private capital flows coming into the fintech space? It's something we may want to consider for future research.
Yeah.
So briefly, these are some areas that can be looked at.
No, absolutely useful. Thanks, Josh. I agree with you. Our researchers are now working on how to expand and test various measures of inclusive growth, which extend the idea that growth has to be inclusive. That's another dimension, or sometimes fusing inclusive growth, poverty, and dealing also with issues of reducing inequality. I suppose that Aisha is already hammering away at some of those questions of linking to inequality measures together with growth. So yes, there are other dimensions, and I think you are quite right. There are also dimensions of capital flows with the performance of domestic banking institutions, not in terms of financial inclusion, but in terms of actual performance or measures of performance ex ante and ex post. And also, of course, the performance of domestic capital markets, especially bond markets, where some of those flows may end up being absorbed in the bond markets, selling both foreign bonds and domestic bonds. Absolutely useful, helpful, informative, and motivating. Your paper is to motivate other researchers to look into this particular area. And by the time the paper comes out in the journal, it will already have research impact flowing to in terms of people who are working in this particular area. Yeah. Okay, I can see a number of people here. Some sending apologies, and some continuously putting information in the chat. Now, let me see whether there is anybody show of hands. No, no more. So I say, Joshua, you've done great work. Excellent paper. Thank you very much for sharing this with us. Oh, then there is a comment. I think a comment or some. Yes, Dr. Peter Rose, I can see some flicker from your end. Do you want to say something?
Yes.
Thank you.
Thank you, Professor Murinde. Thank you, Professor Joshua. One last question from me. There's a concern about people losing their jobs, company closed down, business fails. One of the hot capital flowing to developed countries is the diaspora's flows, like Professor Murinde. So it's an issue that is of grave concern. How do we promote inclusive growth when we have diaspora's funds being stuck somewhere outside? Thank you.
So let me be sure I got a question. So we are looking at diaspora flows into the local economy. Is that correct?
Yes. I
Okay,
think that's the thrust. Yeah.
Okay. So if these are in the form of remittances, the standard literature, and of course, I mean some of my papers, we found that remittances, when it comes into the financial system, especially through the banking sector, it has the tendency of increasing credit extension and therefore promoting growth. So remittances through the formal financial system, especially the banking system, is very useful for the local financial sector because banks can then mobilize these and package them in the form of loan products for the market. And you expect deficit units to access these to finance production and drive growth.
Yeah. Thanks very much. I think that's absolutely helpful. In terms of, I think all this work is about trying to understand the channels, how it happens, and that's absolutely spot on. Okay, so I think we are drawing to a close of this seminar. So once again, let me thank you, Joshua, for taking the time to share with us this important paper, the findings, and to enjoy the discussion and the comments made. I think that not only enriches our knowledge in this area of practical flows and financial inclusion around the world, but also I think may give you feedback to be able to complete this paper to the highest quality possible, and then we continue this interesting piece of work. And as I mentioned before, it's quite highly likely that this discussion here has indeed fed into great ideas for people who are working in this area and for promoting further research, both in a regional context, but also, globally, and to look for other areas that maybe you have not covered, so that your work is providing a platform for extension of more knowledge, looking for more knowledge, and trying to get this knowledge translate into either better practice or better policy. Thank you very much. We are highly indebted to you, Joshua, for this. And thank you, participants, once again, for finding the time and to be able to join this discussion. This discussion take place because we all come together to share this knowledge and to exchange ideas. It wouldn't happen without all of us being able to sacrifice this Wednesday afternoon and get together to share interesting research and to work together on new dimensions. So I look forward to seeing you here next week on a Wednesday. And thank you, Meng, for this coordination behind the scenes. And Meng will be in touch with you with further information on the way forward. A couple of seminars before we all break for Christmas. Thank you very much, and bye-bye.